You are listening to The Vocal Technologist. Spoken tech for your ears.
Imagine your personal digital wallet gets into an argument with a paywall.
Oh, that sounds exhausting already.
Right. But picture it. You are fast asleep in your bed, but your wallet is wide awake. It is aggressively negotiating a micropayment to read a single financial article on a locked website.
Just fighting for a bargain while you were dreaming.
Exactly. And once the price is agreed upon, it settles the bill instantly in a currency that literally did not exist a decade ago. It sounds entirely absurd, like a scene from a science fiction novel.
Yeah, but the crazy part is that it is not fiction at all.
No, it is the actual financial plumbing being built as we speak. So our mission here is to unpack how artificial intelligence agents are moving from being passive chatbots that just, help you write emails to active financial participants with their own digital wallets.
Because it is a fundamental restructuring of how capital actually moves.
Mm-hmm.
For a very long time, money has been something you actively have to manage. You log in, you click buttons, you authorize transfers.
Yeah, it is a manual chore.
Spot on. What we are exploring here is the mechanical reality of money becoming something that manages itself.
And we are going to pull apart exactly how that works for you, the curious, time-poor professional. Because you cannot have autonomous agents running around on banking rails that shut down for the weekend. We need to look under the hood at the new programmable plumbing.
Absolutely.
So let us get straight into what people are calling the agentic era of money. You look at Starling Bank right now, and they are rolling out an agentic money manager built on Google Gemini. But what does that actually mean mechanically? Instead of me clicking buttons, what is the artificial intelligence doing?
Well, mechanically, it is translating your natural language into executable database commands. Previously, if you wanted to, say, track your spending or move money into a savings goal, you had to navigate a graphical user interface.
Right, you had to find the right menu, type in the numbers, all that.
Exactly. With the Gemini integration, you simply speak or type an instruction. You tell it to cancel your streaming subscriptions if you have not watched anything in a month.
Oh, wow, so it just hunts it down.
Yeah, the artificial intelligence reads that intent, translates it into an application programming interface call, searches your transaction history to identify the merchant, cross-references your usage data, and then autonomously executes the cancellation protocol with the bank backend systems.
That is wild, which feeds perfectly into this broader concept of the wallet wars.
Right.
The next massive consumer finance product is not going to be an app with a sleek interface. It is going to be a personal finance agent.
And the clever part is how they're building it.
Yeah, they're building it backward into the financial infrastructure. It is very similar to how Stripe conquered online payments. Stripe did not try to build a traditional consumer bank. They built a few lines of elegant code for developers to accept credit cards, and then they built backward into the messy global financial system.
It is the exact same playbook. These artificial intelligence agents are becoming the invisible layer on top of your money. That backward integration is the critical piece. They provide a layer of intelligence that sits across all your existing fragmented accounts. And the legacy financial institutions are acutely aware that they risk becoming nothing more than dumb pipes if they do not adapt.
Which explains the massive internal panic, shift happening at legacy companies. Look at American Express. The scale there is staggering. They have 11,000 engineers currently using artificial intelligence to reduce their coding time by over 30%.
It is a massive structural shift.
Wait, let us pause on that number for a second. 30% of an engineer day being freed up across an army of 11,000 people is a huge chunk of human capital. What are they actually doing with all that extra time?
They are completely rebuilding their internal architecture. American Express is viewing this as a structural redesign of their entire operation rather than just a simple cost-cutting tool.
Because the agents need to talk directly to them.
Exactly. If an autonomous agent is going to negotiate a purchase on your behalf, it cannot navigate a human-facing website.
Yeah.
It needs to talk to the American Express machine to machine instantly.
So those engineers are literally laying the tracks. They're building the very infrastructure required to support these new agent-led commerce platforms.
Spot on. But I know what you are thinking. Whenever we talk about structural redesigns and machines doing the work of humans, everyone immediately panics about their jobs.
Oh, absolutely. And there was a massive survey of 750 chief financial officers asking exactly this. Interestingly, they're predicting a very modest 0.4% overall headcount reduction because of artificial intelligence.
Which sounds comforting on the surface.
Right, but the devil is absolutely in the details there. That reduction disproportionately wipes out entry-level clerical roles while actually augmenting the highly technical ones.
Yes, it is a textbook example of skill-biased technological change. We have to look at the mechanics of the tasks involved. If your job primarily involves extracting data from one invoice and pasting it into a spreadsheet, well, an agent can execute that instantly and flawlessly.
So that role just vanishes.
It does. But if your job involves complex technical strategy, interpreting regulatory changes, or managing nuanced client relationships, the machine does not replace you. It just hands you the data you need instantly, making you significantly faster and more effective.
So it is not mass unemployment, it is more of a gradual workforce reallocation.
Precisely. And it is becoming entirely non-negotiable for survival.
Yeah, Rishi Sunak, acting as an advisor to Goldman Sachs clients, was incredibly blunt about this dynamic. He told small businesses that artificial intelligence adoption is absolute table stakes just to stay alive in the market.
And the data absolutely backs them up. 98% of the small firms they surveyed are already using it in some capacity.
98%, that is basically everyone.
Because if you are a small business competing against a massive multinational corporation, an agent is the ultimate equalizer. It can effectively do the administrative and analytical work of a 5-person finance department for a fraction of the cost.
So it processes the payroll, analyses the supply chain costs, flags discrepancies, all while the owner actually focuses on growing the business.
Exactly. It frees up the humans to do human things.
Let me stop you there, though, because I have to push back on this idea of complete financial autonomy. We are talking about these agents running our financial lives, but are regular people actually ready to hand over the keys?
That is the big question, isn't it?
Because there is a survey from TD showing that while 78% of Americans use artificial intelligence regularly, only 18% actually trust it to make independent financial decisions.
Right. There's a massive trust deficit.
Yeah, my analogy for this is simple. We absolutely want the machine to do the complex spreadsheets, but we categorically refuse to let it hold the steering wheel. We do not trust the machine with the actual money yet.
And that hesitation is the exact reason why agentic finance must be integrated incredibly slowly. We are looking at a massive psychological barrier.
So they cannot just flip a switch.
No, not at all. You have this huge gap right now between internal corporate efficiency, which is skyrocketing, and consumer-facing trust, which is severely lagging. The banks have to bridge that gap carefully.
Right. You cannot just unleash an autonomous trading bot on someone's retirement account.
Exactly. They have to start with small, low-risk actions. First, it just categorizes your spending. Then maybe it suggests a budget. Then it asks for your permission to move $50 into savings. Trust is built through successful, transparent iterations.
But here is the physical bottleneck in all of this. Let us say you do trust the agent. You have one ready to negotiate micropayments 24/7 at the speed of light.
Okay, fair enough.
But if it tries to execute that trade at 5:01 on a Friday afternoon, the traditional banking system tells it to wait until Monday morning.
Oh, the classic weekend closure.
Right. You cannot put a Ferrari engine on a wooden carriage. That structural friction is forcing the creation of a totally new settlement layer.
Exactly. And this is the direct causal link from the agents to the new infrastructure. An agent operates around the clock. It does not sleep, and it does not observe public holidays. Therefore, it needs a settlement layer that also operates around the clock.
Which brings us to the programmable plumbing. That physical requirement is driving the quiet revolution of stablecoins and tokenized assets.
It's entirely necessary. Traditional banking is basically like sending money via the postal service. It leaves your bank, stops at a sorting facility, maybe gets handed off to an intermediary bank, and each stop takes time and incurs a fee.
Yeah, it is painfully slow. Whereas stablecoins are like teleporting the money directly into the merchant vault, with the transaction rules permanently baked into the digital dollar bill itself.
That is a great way to put it.
Look at what Naim is doing. They are launching a platform to issue stablecoin-funded cards across the Visa and MasterCard networks using a single application programming interface.
And the mechanism there is brilliant because it removes the infrastructure complexity for the user. When you swipe that card at a coffee shop, the merchant receives traditional fiat dollars instantly.
Right. They do not even know crypto is involved.
Exactly. But on the back end, your stablecoin balance is what actually gets deducted. The conversion happens in milliseconds.
Then you have Ramp launching a public beta for stablecoin accounts. Businesses can hold funds, earn rewards, and pay vendors globally in one unified system.
Yeah.
They are bypassing the traditional correspondent banking system entirely.
And the correspondent banking system is notoriously painful.
Oh, it is the worst. When you send money cross-border traditionally, it bounces through Nostro and Vostro accounts held by intermediary banks, getting clipped for fees every single time.
It is just rent extraction at every stop.
Exactly. So OpenFX just raised $94 million to process $45 billion in cross-border settlement volume. They are positioning stablecoins as the direct technological replacement for those decades-old foreign exchange systems.
Because stablecoins settle in seconds, peer-to-peer. There are no intermediary banks extracting rent from the transaction.
It is just a direct line.
Spot on. We are also seeing Bridge expand its fiat to stablecoin infrastructure by adding British pound rails. And Ripple is introducing a treasury management system that tracks digital assets right alongside traditional cash.
So they are finally putting the new programmable money and the old fiat money on the exact same corporate dashboard.
Yes, blending the two worlds.
But speaking of blending the old and the new, here is something that genuinely made me pause. Better Home and Coinbase have partnered on a crypto mortgage product.
I saw this. It is quite a move.
Buyers can use Bitcoin or USDC to support a down payment without actually selling their crypto. The mechanics are wild. They are bundling a second loan, which is backed by your digital assets, with a standard conforming mortgage.
It is a fascinating piece of financial engineering.
Which, yeah, is exactly as terrifying as it sounds, because you are essentially strapping a highly volatile asset to a 30-year house loan. I mean, if the crypto market tanks, your down payment collateral just evaporates.
Look, it absolutely introduces a new vector of risk. There's no denying that. But if we connect this to the broader structural shift, it shows how the crypto sector is desperately trying to pivot away from casino-style speculation.
Right. They want to be seen as legitimate.
Exactly. They realize that to survive, they have to integrate these digital assets directly into boring, everyday enterprise settlement and traditional financial products, like mortgages.
Right, which inevitably brings the regulators knocking at the door. And we need to be very clear here. We are not taking any political sides, right-wing or left-wing. We are purely looking at the market mechanics and the reality of the regulations being proposed.
Fair enough. It is a complex environment.
On one hand, you have lawmakers pushing for tokenized securities frameworks. They want to bring digital stocks and bonds into mainstream markets because they want the efficiency of blockchain settlement.
They want the speed and the transparency.
But on the other hand, you have proposals like the Clarity Act. The stated goal of the act is to ban stablecoin yield to protect traditional banks from deposit flight.
Because regulators are worried that if stablecoins offer high interest rates, consumers will pull all their money out of regional banks, causing a massive liquidity crisis.
Yeah, which makes sense from a protection standpoint. But if we observe the mechanics impartially, this proposed ban wipes out the revenue sharing model for companies like USDC.
How so?
Well, USDC makes money by taking your dollars, buying safe treasury bills, and earning yield. If they cannot do that, their business model basically fractures.
Oh, I see.
But the fascinating part and the real irony here is that it leaves their biggest competitor, Tether, entirely unaffected, because Tether operates offshore and outside that specific regulatory perimeter.
So it completely misses the target.
Exactly. So the unintended consequence is that it pushes capital toward decentralized finance platforms where yield is still available. Again, just observing the board here. But it is a massive reshaping of where value actually accrues in the system.
It is an incredibly delicate balancing act. Regulators absolutely want the technological benefits of programmable money. They want the instant settlement and the reduced friction. But they are terrified of destabilizing the traditional banking sector in the process.
So what happens when the established financial titans see this new programmable infrastructure being built right under their noses? I mean, they do not just sit on the sidelines and watch their margins evaporate. They either buy the data or they retreat to their strongholds. And the moves being made by traditional finance right now are aggressive. Let us look at the Intercontinental Exchange, the parent company of the New York Stock Exchange.
They have been making some massive moves.
Yeah, they just completed a $2 billion commitment with a fresh $600 million investment into the prediction market, Polymarket.
Polymarket has been entirely fascinating to watch. It is a decentralized platform where users bet crypto on the outcomes of real-world events.
Right, and the Intercontinental Exchange is making this massive investment while federal prosecutors are actively probing Polymarket for insider trading and market manipulation.
It is a bold move given the scrutiny.
It is wild. So ICE is pouring $600 million into a platform that is being raided by the government. It is an incredibly aggressive, almost reckless play. It is basically like buying a casino just so you can monitor the heart rates of the gamblers.
That is a brilliant analogy, and it is precisely the mechanical value here. The Intercontinental Exchange does not care about the individual bets or the crypto mechanics. They want the raw, real-time sentiment data.
Because it is faster than any poll.
Exactly. A prediction market forces people to put their money where their mouth is, which makes it aggregate human, and increasingly artificial intelligence sentiment significantly faster and more accurately than any traditional poll.
And if you own the New York Stock Exchange, owning the fastest sentiment engine in the world is a strategic imperative. You are buying the informational plumbing.
Spot on. You are buying the future data flow.
Meanwhile, Visa is attacking a different kind of plumbing. They are rolling out an in-app subscription management service. Global subscriptions are projected to hit 12 billion. People are completely drowning in recurring charges.
Oh, absolutely. Everyone has 3 streaming services they do not even watch.
Right. And this ties right back to our artificial intelligence agents, because agentic payments could unlock multi-layered revenue streams for content platforms. Instead of a blanket monthly subscription to a newspaper, an artificial intelligence could negotiate a pay-per-article micropayment on your behalf.
Which completely changes the unit economics of media.
Or platforms could charge pay-to-preview fees for artificial intelligence crawlers trying to scrape their data.
It completely rebalances the economic incentives of the internet. Right now, artificial intelligence companies scrape data for free.
Yeah, they just take it.
Exactly. But if a platform can use an embedded micropayment protocol, they can charge that agent a fraction of a cent for every sentence it reads, settled instantly in stablecoins.
So Visa sees this incredibly complex web of recurring payments and machine-to-machine micropayments forming, and they want to be the central dashboard where consumers manage it all.
They want to be the toll booth.
Exactly. Let us look under the hood of banking profitability, because the contrast between the new players and the old guard is stark. Revolut just hit a massive $2.3 billion profit, and they are planning to become a primary lending bank in the UK.
They are firing on all cylinders.
They really are. But then you have Monzo, another massive digital darling, entirely shutting down its U.S. operations to focus strictly on the U.K. and Europe. What is going on there?
It highlights the mechanical friction of geographic expansion in banking. The U.S. market is not one cohesive system. It is incredibly fragmented from a regulatory standpoint across 50 different states.
Oh, right. It is a nightmare of compliance.
Exactly. Revolut is succeeding by converting millions of their secondary travel card users into primary full-service banking customers. Monzo realized the customer acquisition cost for primary accounts in the U.S. was simply too high.
The unit economics just did not work.
No, they did not. So they retreated to their strongest market.
Fair enough. Then you have infrastructure players like Plaid who are sitting back and waiting patiently for the perfect initial public offering window. They are boasting $500 million in annual recurring revenue and 40% growth.
They're in a very comfortable position.
Yeah, they have so much cash flexibility that they are out acquiring media companies like This Week in FinTech. They are trying to build a community layer on top of their technological infrastructure.
Plaid is demonstrating the immense power of owning the connective tissue. They provide the application programming interfaces that let all these different financial apps talk to your traditional bank.
So they sit right in the middle of everything.
Right. Because they own that critical junction, their underlying unit economics are incredibly strong. They do not need to rush a public offering.
Now, contrast that technological agility with the traditional banking consolidation we are seeing. Sedato is exploring a major regional bank acquisition specifically to boost its deposit base.
Because despite their immense size, they have a structural weakness in retail deposits compared to their peers.
And UBS just secured full approval for a U.S. national bank charter to aggressively expand its domestic footprint. The old guard is consolidating hard assets and regulatory charters, while the tech firms build the new digital rails.
It is a massive land grab on both sides. And then you have companies caught violently somewhere in the middle, like Klarna.
Right.
They are fundamentally a technology company acting as a traditional lender, and they are struggling massively with loan loss accounting.
Break down the mechanics of that accounting for us because it makes a highly profitable business look like it is bleeding cash on paper.
Yeah, it is a bit counterintuitive. Let us say Klarna issues a $1,000 consumer loan to be paid back over 5 years. Accounting rules dictate that they have to estimate the potential future losses of that loan, say $100, and recognize that loss immediately upfront on their balance sheet.
So they take the hit right away.
Yes. But they can only recognize the revenue from the interest payments a few dollars at a time, spread out over the next 60 months.
Wow. So they take the full hit of the risk on day one, but get the reward slowly over 5 years.
Exactly. This accounting dynamic creates massive near-term earnings volatility, which absolutely terrifies public market investors.
It is the ultimate clash of worlds. You have rapid technological scale crashing headfirst into traditional conservative accounting realities, which leads me to an observation that I find deeply ironic.
Oh, do tell.
We have spent this entire time unpacking how the financial industry is racing to build agentic crypto payments, teleporting stablecoins across borders in milliseconds, and setting up machine-to-machine micropayments.
Right, the absolute bleeding edge of finance.
And meanwhile, New York State just literally had to pass a law forcing stores to accept physical cash.
That is just brilliant. It is the perfect encapsulation of the societal friction we are navigating.
It really is.
You have a highly technical segment of the economy designing digital agents that trade stablecoins at the speed of light, and you have another vast segment of the population that just wants to buy a carton of milk with a $5 bill without being turned away at the register.
And both realities exist at the exact same time.
They do. The ultimate tension of the next decade is figuring out how we bridge those two completely divergent realities.
Which leaves us with a rather profound final thought to mull over. We have talked entirely about artificial intelligence agents negotiating on our behalf to save us money. But what actually happens to the global macroeconomic system when your personal financial artificial intelligence starts ruthlessly negotiating against your bank artificial intelligence at the speed of light? It is something you will definitely want to keep thinking about. If you want to keep exploring these technical shifts without getting bogged down in the chatter, keep listening to Vocal Technologist. We will keep pulling the future apart for you.
Spoken Tech for your ears.